Well, good day, ladies and gentlemen. My name's Chris Weston. I'm head of research here at Pepperstone. We're going to be going through the macro environment of which we find ourselves trading at the moment, with a specific flavour on gold and precious metals. But we'll be looking at FX markets, we'll be looking at commodities more broadly, and also a touch on crypto, if we will, and certainly fixed income, which of course is so influential to the gold market that we find ourselves in at the moment. But for anyone who's finding themselves thinking that we're going to wind down into the festive period, I think we need to have an open mind. I think there's some big event risk. I think in some ways, some capacity, we're probably already looking ahead at that event risk and pricing ourselves accordingly. The markets live in the future, they don't live in the present. And I think we are looking at some of this big event risk and saying, what if this happens, and pricing those scenarios accordingly. That's what we do. We price in a set of assumptions, and then obviously we pare that back once we get the facts. But I think the event risk that we have in December is significant, and if participation does fall, then we could have some higher volatility in markets. So let's go into the markets, and let's start with an overview of the gold market, because ultimately that's what a lot of people are trading here. And I'm looking at gold in US dollar terms, XAU USD. Of course, that's where we see the predominant amount of our flow, and you can see that these precious metal markets have been pretty volatile. They've seen some big drawdown. Palladium down 14%. That's a significant move. Gold down 4.1%. Silver down 6.3%. But that's obviously a large amount of that is down to what we're seeing in the strength in the dollar. Let's have a look at the markets more broadly. Let's have a look at the FX markets traded against the US dollar, and you can see that these currencies have all lost ground against the US dollar over the last 5 days. The MEX down 2.8%. The Rand down 2.3%. You get some of the Scandis down 1.9 or 2%, 1.7%, and you can genuinely see that the US dollar has really found its mojo at the moment. A lot of that is down to the smile theory. So if anyone who is a budding currency trader there and hasn't heard of the US dollar smile theory, then please do go and Google it. There's a huge amount of literature out there, and that basically tells you that how the dollar should, in a simplistic world, react to the current environment. And at the moment, I think you've got two factors working for it. One is the cyclicality. There's no central bank or no economy in the developed world that has a higher inflation rate other than the US at the moment. Okay, there's places like New Zealand where we've just seen them raise 25 basis points, and if you look at the curve for the swaps market, they are expected to be still more aggressive than the US. But the Fed now are probably going to embark on a rate hike cycle, and we'll talk about that more in a moment. But from a cyclical perspective, we like the dollar. From a safe haven perspective, were we to see volatility kick up, unless it is driven by the debt ceiling, then the dollar works concurrently in that environment as well. So you do have the dollar as a kind of magical beast where it benefits from multiple scenarios, whereas other currencies don't. The Aussie dollar, for example, works on what we call a risk-on, risk-off scenario, which is an awful way of looking at the world, but ultimately that's really, it's driven so much by sentiment, and that's how it trades. But you can see effectively that, how these markets are traded. That's why, being short of gold in the strongest currency, which is the dollar, has always been the beneficial move there. But it's really been about the flows that we've been seeing in the dollar. And I just want to take it out to what we are looking ahead and looking at the volatility structures. So the first one that I've got, this top pane here, is the implied volatility in the rates market. You've got the implied volatility in the bond market. You've got the VIX, which of course looks at the implied volatility over the 30 days in the S&P, and then you've got the G7 volatility index here. I'll go into gold in a moment, but you can see effectively that volatility in rates, interest rate markets, and bond volatility is the highest really since we saw the pandemic. That's really been pushing up quite nicely as we've seen big movement in the bond market. You can see the VIX is really struggling to push above 20%, but I think it's coming. I do think that we're going to see higher vol in that market there. And you can actually see, despite people saying that there's not a lot of volatility in the FX market, well, it has been creeping up. Let's sort of bring that in. You can see that really, as the dollar's gone on a one-way move, that the implied vol has moved up, and you can see it's going from around 6% up to 7%, which is still the highest levels really since February of this year. So implied vol in FX markets has picked up, and I think that's really a really interesting scenario. Now let's have a look at the calendar ahead of us. And you can see as we go into the week ahead, core PCE numbers come out in the session ahead. Now, look, the deflator is expected to push up from 4.4% to 5.1%. Now, think about the Fed's projections of economics going forward. Now, for this year, and you can bring up on their site, they've got core PCE inflation at 3.7%. Well, given that we saw in the last, the monthly reading, 4.4%, and this number at 5.1%, that 3.7% for the quarter, for that December quarter is looking very, very weak indeed. Now, obviously, that could come out higher than 5.1% or lower. We don't know what that's going to be, but I think that could be very influential. It does make us believe that when we get the Fed meeting coming out on the 16th of December, that they're going to have to massively upgrade their inflation expectations for this year and maybe also for next year as well. Is inflation transitory? What does transitory actually mean? Clearly, prices are going to be higher for a longer period of time. And I think the Fed probably need to change the way they communicate interest rates going forward, and rather than saying inflation's transitory, but if it changes, then we're going to raise rates. I think they probably need to change their tune and actually say, well, you know what? We're going to be looking to raise rates in 2022 unless it does prove to be transitory. So I think they need to flip their model on their head effectively and start laying the foundations for interest rate hikes. Of course, we got Powell getting his remuneration going forward. But that's an interesting one. We've got ISM manufacturing numbers coming out on the 2nd there. The payrolls number on the 4th. The big one there you'll look at is the participation rate, where the market's looking for that to tick up to 61.7%. Yeah, that's still not, in the eyes of the Federal Reserve, that participation rate is going to be coming up to 62.5 or so. It's a big one there. And then you've got payrolls expected to be 500,000. I'm actually not an economist. I'm not a qualified economist. But I do personally believe that some of those seasonal adjustments will come out the market. I think we're going to see it top side of 500,000. A lot of the data in the US is beating expectations at the moment. The next one there, I think this is an absolute blockbuster. Everyone should be watching this one. On the 11th of December, you've got CPI numbers. I'm very US-centric at the moment, but I think the gold market and the dollar, everything is looking very much at what's happening there. But the market is expecting inflation of 0.7%. The most important one, there's nothing there at the moment, but I think the headline number that you need to look at, because it involves energy prices, and it doesn't make a lot of sense at this point when everyone's feeling energy, and how that hurts them. And obviously the fact that Biden's pushing so much energy into trying to release SPRs into the market to try and lower gasoline and energy prices more broadly. That inflation number, I think, is going to be above 7%. Above 7.2%, that's going to be the highest headline inflation read in the US since 1982. I was a mere 2-year-old at the time. But you can see there that the market is I think that they're going to see it above 7%. And that inflation number is only going to tick higher. That could be the market saying, you know what, enough's enough. We're going to buy volatility, and that's going to set the market up. Obviously, if I'm thinking about it, a lot of other people are thinking about it, and that means it probably won't come true. But that's really something that I think could break the straw, the camel's back. We've got retail sales, not too concerned about. The Fed meeting on the 16th of December, that's going to be a massive one. I've talked about the idea that the Fed probably need to set the change for interest rates, but they're probably going to taper their QE program much more significantly. The market's already reacting to that. Richard Clarida, the vice chair, let the cat out of the bag last week when he said they were going to potentially accelerate their QE program, or the pace of the tapering going forward. It's going to be a big one. Unemployment numbers, we'll have to see what they come out with, that payrolls number. But everything, if you look at the Fed's projections, they're way out of kilter at the moment. They need to taper quicker. They need to change the way that they're approaching interest rates next year, and they also need to change their forecasts quite significantly. That's before we even start talking about dot plot projections. So my point being is that there's some significant event risk to look at here, and that's also on the same day as the ECB meeting and the Bank of England meeting, where we're potentially going to get a 15 basis point hike. Certainly that's my call there. What causes bigger volatility? And apologies for getting off the bond market here. First of all, break-even rates. Now, I'm not looking at the break-even rates you derive from just generic difference between TIPS and generic treasuries. This is the one the Fed used. I think above 250 in this five-year forward inflation break-even rate, which a lot of people won't see. This is something that you can probably see on the Fed's website, the Fed website. But at 240 at the moment, this is expected inflation's over starting in 5 years' time for 5 years forward. And this is the Fed's model that they would use amongst one of many others, is that inflation would be about 240. I think it breaks 250, and I think the market would take notice of that. I think that would cause bigger volatility in market at the moment. This is the inflation gauge that I really like to look at. It's a little bit lagging, but I think above 250, I think the market wears a higher risk premium going forward. Also, one I like to look at is what the market's considered to be the expected long-run terminal rate of the Fed. Go back to 2018, and Jerome Powell made an absolute calamity of a communication error, telling everyone that they were still a long way from the neutral rate, and they were prepared to go above the neutral rate. And you can see here that that neutral rate now, or in terms of the Fed's projections of the terminal rate, is 2.5% for the Fed funds rate. We're at 2.05 at the moment. I reckon if we got close to that 250, the equity market would go through significant drawdown. And I think that would be the point where we say that, you know, policy is getting too tight. And that's another factor that I'm looking at very, very closely indeed. The other factor, of course, is real rates. Real rates, you know, is the cost of capital in the market. It's inflation-adjusted treasuries, or treasuries adjusted for inflation expectations. You can see that we've seen 10-year real rates in the US going from -121 to -97. So that has picked up. They've become less negative. And look at what the gold market's done. I'm going to focus in and come in a little bit more. But you can see the inverse relationship has obviously picked up. But what's also happened is real rates, again, this is just the 10-year real rate, has become less negative. Then we've seen the US dollar obviously working quite nicely in that situation. So that correlation looks like it's picked up a little bit. So for the gold market, we've seen real rates moving higher. The gold market doesn't like that at all. And we've seen the US dollar moving broadly across all currencies. It's working beautifully at the moment. And if we go to our charts, let's have a look at the front end of the US curve, because what we do is we look at the 2-year treasury, because the front end of the curve always looks at, you know, rates pricing. The back end of the curve involves things like inflation expectations, term premium, and other factors as well. But the 2-year treasury, there's a bit of a dodgy spike coming through on my trading view charts. You can see this, ignore that. But you can see they've traded from around 20 basis points up to 61 basis points. So there's been a material shift in terms of rates pricing, and the dollar really has become very sensitive to rates pricing. We've seen a similar situation in 5-year treasuries, but if you look at the difference between 5-year US treasuries and the premium that wears over German treasuries, and again, this just dictates where capital's going, because you want to be in the places where bond markets are selling off in a way, because you can achieve higher yields, higher relative yields, and also it's a sign that, you know, your capital's working harder because the economy's looking good. But you can see there that you know, we've gone from around 141 premium of US treasuries to, you know, nearly 2% effectively, and the US dollar's gone along for the ride there. So, well, can that continue? I'm not so sure it can, to be honest, but that's really what the US dollar's been driving on in that situation, and rally it has. I mean, have a look at this chart of the dollar index. It's just gone for it, absolutely. When it broke through 94 sort of 60 or so, it's just gone on a one-way tail. We saw a little bit of a pullback there. Pullbacks are supported into the 5-day exponential moving average. I remain a US dollar bull. It's scary being a US dollar bull after all these factors. But what I'm looking at is a price until it can close below that 5-day moving average. I'm still staying long in this pair at the moment. And I think, yeah, euro dollar is obviously a big factor that we're seeing playing into that. It's oversold. Yeah, we know it's oversold. But again, just continuing to stay short. I'll be looking to close any long or any short positions here on a daily close above this 5-day exponential moving average, and potentially even looking to add to those positions. But it is a bit overcooked. It's a bit underloved, I suppose. So I think that there is a real rising probability that we do see the US dollar sell off a little bit in the short term, and that will present itself as an opportunity. Let's go into the gold market, because that's ultimately why a lot of you are here. And you know, let's have a look at that price action that we've seen in real rates. Now, we saw that obviously explosive move up there. Last week we were talking about this bearish outside day reversal, this engulfing pattern that come through, and whether or not price could actually sell off through that level. So we were looking at short sell positions or stop positions, and looking to ride that momentum should it go down. But obviously, as you can see, we haven't seen that, and the bulls have defended those lows. That's what you want to see on those engulfing patterns. When there's a change of ownership and you see the sellers now seemingly in control, we then need to see confirmation. Does the sellers continue to push that lower? And the bulls have defended that, and obviously they've paid the price to do so. But once we actually did get a close and a breakthrough of those levels, then it was game on. It was game on to be short. What we're looking at now is the price holding this 50-day exponential moving average. And, we've actually seen some support coming through there. So time to time, the 50-day will act as support. A lot of mean reversion traders like to use the 50-day moving average. But we are starting to see support now. So if it is my view that the US dollar is probably a little bit overcooked, a bit overloved, and it pulls back a little bit, and we do see real rates come down a little bit as well, then perhaps gold could rally back up into these levels into 1811 and back into the 5-day exponential moving average. Also, yesterday's high. So that could be something that we want to look at. That might be the level to look to reinitiate short positions, but that's where I'd be looking at the moment. Let's have a look at it against the Japanese yen. We've obviously seen a similar situation across all currencies. One I'd like to look at the moment is what's happening in the gold-silver ratio. This is one that's come on my radar, and you can take a lot of the macro factors out there, but you're generally seeing a situation here where gold is the numerator and silver is the denominator. So if this is going up, it means that gold's outperforming silver. It's a market, let's call it a market neutral strategy, or a long-short strategy, or a pairs trade effectively. But you can see here a break of this 50-day exponential moving average, a break of these highs of 76 on that ratio. Then I think that long positions are probably quite good for 78, perhaps a little bit higher. The way to place that is you start with a US dollar amount, a notional, for example, start with 50,000, and then you divide each side by 50,000, or 50,000 by the price of gold, and then by silver, and then you can effectively go long gold and short of silver and get the position size right. And if the position was to go up, we can sort of recalibrate that position by taking a bit off the top to keep those exposures, those notionals, the same. It's a really great way of trading. I love doing it myself. But I want to wait for a break and push through this kind of these levels here, 76.35. On that situation, then I'd probably be looking to go long gold and short of silver for a move back up into 79, also 78, 78.50 into 79. And as that continues to move, I look to recalibrate that. I think that's an interesting one. We go back into the oil market. Big moves playing through there last night, and again, this just plays into inflation expectations. I showed a chart there earlier about the Fed's inflation expectations being around 240, and you can look at break-evens or other different types of market-based levels of inflation. A lot of it is down to what we're seeing in gasoline, Brent prices, crude prices, nat gas prices. And what we saw overnight, really interesting, was the US and China and Japan and India and Korea and the UK as well, releasing 50 million barrels of crude into the wild effectively. There's some nuance around that because some of it's on an exchange basis, but the market rallied. Now the market was looking for more. It was probably priced in. I've written an article on the website for anyone who's interested, but this really needs to break through the 50-day moving average, and I think it needs to break through through these highs around 79.36 for us to really get back up into 80. And I think if we can get back above 80, which I think probably is also the midway of the Dolchin channel. We put a 20-day Dolchin channel there. Let's have a look at that. Yeah, $80 there. So you can see the 20-day high, 20-day low. That comes in the midpoint there around 80. So I think a break of 80, and I think people will start adding length to oil for a move back into what's obviously very, very strong resistance into that sort of 86 level. But I think if oil prices are moving higher, if nat gas prices, which are building a base, you can see nat gas prices are clearly building a base. If that was to make a move higher into the 50-day, then I think inflation expectations are going to go up a little bit as well, and that could cause some gyrations in markets as well. It could actually be good for the gold market because it could lower real rates in that situation. So one we are watching. I think it's really interesting to see as we go through there. I've given a sort of a clear overview about what's going on in there. The other thing that we want to look at is what's going on in the rates market. Now, this is another chart that I've got of probably the three big ones which really do concern me at the moment. Rate hikes are expected to be front-loaded. Get them in early, go hard, go home, and not worry about having to do it later on. What am I looking for is the signs of a policy mistake. Now, if you have a look at this chart here, you can see that in terms of what's being priced in over the next year, we can see 2.6 rate hikes being priced into the Fed funds curve or the swaps curve by next year. If that was to go above 3 rate hikes, I think the market would worry a little bit. But what I'm looking at here, and this is quite technical, is what's priced into rates markets, euro dollar futures, between 22 and 21, we can see 76 basis points, and 22 and 23, you can see 73 basis points, this blue line here. And what's priced in for for 23 to 24, you can see 15. And there's practically nothing priced in for 24 to 25. Now, if that was to go below zero and start pricing in rate cuts, that would be a big red flag to me to buy volatility, to start buying the Japanese yen, to start shorting stocks more aggressively, because the market is saying you're raising rates aggressively, or we're expecting you to raise rates more aggressively, but then we're expecting you to cut. That's a policy mistake in my mind, and I think that's when we start seeing your equity market struggle. So again, I've got a few factors I'm looking at. Break-even rates, five-year Fed break-even rates above 250. I think we're going to see higher volatility. If we see the market's projection of the terminal rate above 250 and the Fed's dot plot projections, higher volatility. And if we start pricing in an element of rate cuts into the rates market, future down the line, higher volatility as well. And I think that could be really, quite beneficial for certain markets, Japanese yen and some of these risk-off currencies. But that's the factor we're looking at. And I think December could be one that really portrays that going forward. So keep an eye out, keep an open mind. And we've also got the debt ceiling to work through as well. So there's a lot really that we need to work for. I've gone on a whirlwind tour today, but just looking for what the event risk is going forward. And it's going to be a big December in my mind. So cancel Christmas, volatility could be back. See you next week.